We often think of banking as a physical process of recycling existing wealth. You deposit your paycheck, the bank keeps a fraction, and then lends the rest to a borrower. It's a simple model where your savings are locked safely in a vault, waiting to be used by someone else. In 2014, an economics professor named Richard Werner wanted to test if this model matched reality. He convinced a small German bank to let him observe their internal systems while a real loan was being processed, providing a rare look at where the money actually originates. Werner observed that no physical vaults were opened and no existing deposits were moved from other accounts. Instead, once the loan was approved, the bank simply updated its digital records. In that moment, funds appeared in the borrower's account that had not existed seconds earlier. This reality is often difficult to accept because we assume a system this important must involve tangible assets like gold bars or complex physical machinery. But relying on the myth of the vault makes it difficult to understand how the modern economy functions. To navigate your own finances effectively, you have to look at the actual rules governing the creation of credit. To identify the source of this new credit, we have to distinguish between the three different types of money currently in use. The first tier is central bank reserves. These are used exclusively by banks to settle payments with each other. This is a closed system that the general public never accesses or sees. The second tier is physical cash. While these notes and coins are what we usually picture when we think of money, they represent a surprisingly tiny percentage of the total money supply in the economy. The third and largest tier is commercial bank money. This consists of the digital entries that make up our salaries, mortgages, and savings accounts. Because commercial bank money makes up the vast majority of our economy, it is private banks, rather than the government, that generate the bulk of the purchasing power we use every day. Money generation happens through double-entry bookkeeping, requiring two matching entries. When you take a $20,000 loan, the bank records your promise to pay as an asset. Simultaneously, they credit your account with $20,000, recording it as a liability. The act of recording these two entries is what creates the money. No cash was moved. The accounting entry itself brought the digital funds into existence. This process works in reverse. As you pay back the principal over time, that digital money is deleted from the bank's books and removed from the economy. While the principal disappears, the accumulated interest remains as a profit for the bank. By typing loans into existence and deleting them as they are repaid, commercial banks function as the primary regulator of the total amount of money circulating in the world. While banks can create this credit, they must manage their own risk. This forces them to choose which sectors of the economy receive new money first. A loan to start a new restaurant carries significant risk, as businesses can fail before the debt is fully repaid. This makes lending to new ventures less attractive for a bank's balance sheet. In contrast, a mortgage is secured by a physical house. If a borrower defaults, the bank can seize the property to recover the value. This collateral makes property lending a much safer bet for a bank. This preference for safety often directs the majority of new credit toward the property market. When millions of mortgage approvals create new purchasing power for a limited supply of houses, the result is sustained upward pressure on home prices. Within this framework, rapidly rising home values are linked to the way banks distribute credit. Housing is often the sector where the effects of new money creation are most visible. This system of digital credit eventually intersects with your own daily labor. Think about the hours spent at a desk, on a commute, or working an extra shift. The money you earn is essentially a record of that time and effort. In a digital economy, your bank balance is your labor converted into a spendable form. Understanding credit is about more than just finance. It is about recognizing the exchange rate between your time and the system that dictates your purchasing power. The financial system affects the risks you can take and the freedom you have. By understanding how the mechanics of credit work, you can better navigate the rules that shape your economic life.